because we really need to completely reframe how we look at corporate debt. Look, if you're aiming to build a resilient, high-growth portfolio in this 2026 market, you can just toss the old textbook rules right out the window. They honestly don't apply anymore. We've entered an era where playing it totally safe, well, mathematically speaking, that's actually the riskiest move you can make. So today, we're unpacking the strategic leverage blueprint for high-growth value stocks. It's incredibly natural to fear debt, especially when markets get a little choppy, right? I mean, we've all been wired by past financial crises, or frankly, just standard everyday personal finance advice, to believe that debt is inherently a bad thing. When we see a company with a massive pile of cash and zero liabilities, our brains immediately translate that into safety, security. But I'm going to challenge that assumption right out of the gate. A flawless zero-debt balance sheet absolutely does not automatically make a stock a safe bet. In fact, in today's modern economy, that exact mindset might be the very thing holding your portfolio back from some really massive gains.
Because here's the thing, completely avoiding debt can actually trap you in these stagnant, slow-moving companies, while the real innovators just fly right past you. The fastest-growing companies in the world right now, they don't look at debt as a necessary evil. They view it as raw rocket fuel. The secret isn't avoiding debt at all. The secret is mastering the debt-to-equity ratio to find those rare, incredible innovators that use leverage as a springboard to just completely overwhelm their competition.
So here is our roadmap for today's explainer. First, we're going to bust the zero debt myth, then find the leverage sweet spot those crucial financial red flags, apply a growth velocity filter, and finally, build out your value portfolio.
Okay, starting off with section 1, the zero debt myth. Listen, the old school logic of avoiding debt like the plague is a genuine value trap right now. We really have to look closely at the 2026 interest rate environment. Rates have finally stabilized, sure, but they've settled at a higher baseline than those hyper-low rates we saw in the previous decade. Because of that shift, capital dynamics have fundamentally changed. Sitting on a mountain of cash with zero debt might look awesome on paper, but in reality, it often means a company lacks the vision, the aggressive leadership, or even the technological capability to actually scale. A company hoarding cash is basically just treading water while inflation and aggressive competitors slowly eat away at their market share. In this specific macroeconomic climate, calculated strategic borrowing is a massive competitive advantage. It is literally the primary catalyst separating the absolute market leaders from the companies that are quietly fading into obsolescence.
Which brings us to section 2, the leverage sweet spot.
It's like looking at two completely different worlds. On one side, you've got your legacy value traps. Think of this like the old shift from physical retail to global e-commerce. These legacy companies have zero debt, sure, but they are entirely stagnant. They're relying on outdated models, paying out these agonizingly slow dividends, while their actual market relevance just shrinks every single quarter. On the flip side, you have modern high-growth entities. These guys are strategically leveraged, scaling rapidly, and offering incredibly high upside. They aren't borrowing money just to keep the lights on, no way. They're utilizing complex capital structures to actively dominate their sectors. By the time that legacy company realizes its market share is gone, the modern entity has already used borrowed capital to build an infrastructure that's practically impossible to compete with.
And that leads us to this absolutely phenomenal concept known as the leveraged moat.
Honestly, stop guessing which stocks are going to take off and start looking for this specific dynamic. A leveraged moat happens when a company takes on strategic debt specifically to scale highly proprietary tech. Imagine a company borrowing, say, $10 billion today to build out a massive proprietary AI data center network or maybe a next-gen green hydrogen facility. In these super intensive sectors, capital is a weapon. The debt acts as a springboard, not an anchor. By taking on that leverage right now, they establish a technological monopoly. So by the time a zero-debt competitor finally saves up enough cash to try and build their own version, it's game over. The leverage company has already created an insurmountable competitive advantage.
Let's move on to section 3, spotting financial red flags. Now, obviously, we aren't saying you should just go out and blindly cheer for any company taking on debt. You have to look incredibly closely at what the debt is actually being used for, because there are massive red flags you simply cannot ignore. First up, a rapidly rising debt-to-equity ratio. That can signal a severe liquidity crisis rather than a planned expansion. Second, and this one is highly relevant right now, watch out for companies borrowing strictly to pay off old 2024-era loans. Back in 2024, during those severe rate spikes, a lot of companies took out desperate, high-interest bridge loans just to survive. If a company is borrowing money in 2026 just to service those old toxic debts,
they are completely trapped. And third, if capital is being used to cover basic daily operational overhead instead of aggressive expansion, run away. Seriously, these are the classic traits of a zombie company that's just churning water, pretending to grow while actually decaying from the inside out. But watch out, because there's a sneaky little trap here that catches even the smartest investors completely off guard. At first glance, a balance sheet might look super healthy, and the debt-to-equity ratio might seem totally reasonable. But you've got to dig deeper, because it's often just a mirage. You absolutely must verify if the equity side of that ratio is being artificially inflated by corporate stock buybacks, rather than actual fundamental value creation. See, executives will frequently borrow money simply to buy back their own stock. They're just engineering their earnings per share to look fantastic for their quarterly bonuses, without actually building any new products or entering new markets. If they're financially engineering their numbers to look stable, they do not have a leverage moat. They have a house of cards. All right, Section 4, the growth velocity filter. This right here, this is your master key. To truly know if corporate debt is the good kind or the bad kind, you must understand a concept called return on invested capital, or ROIC. Let's break this down really simply. If a company borrows $1 billion at, let's say, a 6% interest rate, but they use that money to build a proprietary software platform that generates a 15% return on that invested capital, they are essentially minting free wealth. Their ROIC vastly exceeds their debt costs. They are firmly in the growth zone. But if a company is in the danger zone, these zombie companies, their ROIC is actually lagging behind their debt costs. If they borrow at 6% but only generate a 3% return because they're just covering basic overhead, they are mathematically bleeding to death. Calculating this exact difference gives you a definitive filter to prove if their borrowing is actually generating tangible wealth. To put this into perspective, we recently analyzed a concrete case study in the advanced semiconductor space, where a company utilized this exact strategy flawlessly. This manufacturer saw a massive coming surge in processing demands, but instead of sitting around waiting to save cash, they took on significant, calculated leverage at about a 5.5% interest rate to aggressively build next-gen fabrication plants. Because their new microchips were in such incredibly high demand, their return on invested capital skyrocketed past 22%. By crushing their borrowing costs with those massive returns, they literally doubled their overall equity base in a single fiscal year, 2x growth. And the crazy part? They managed to achieve this sheer dominance while their zero-debt competitors completely crashed, totally unable to fund the necessary R&D to stay relevant. Let's move to our final phase, Section 5, building your value portfolio. So, when we take this whole analytical framework and apply it to the broader market, 3 specific sectors absolutely light up as the best targets right now: tech, green energy, and emerging infrastructure. And the reason is pretty simple. These are industries that require staggering upfront capital expenditures. I mean, you can't bootstrap a nationwide EV charging grid, and you certainly can't build a quantum computing lab out of your garage using some spare cash, right? These sectors demand heavy leverage just to get off the ground, but they also offer exponential, monopolistic returns on that investment once the infrastructure is actually in place. Doing the specific low-leverage, high-upside analysis is incredibly predictive of beating a market when you apply it strictly to these 3 intensive sectors. Okay, so here is your concrete step-by-step playbook for wealth building. Step 1, isolate those target sectors: tech, green energy, and emerging infrastructure. Step 2, filter for those low-leverage innovators with aggressive forward-thinking capital structures. Step 3, verify the math. You have to make absolutely sure their return on invested capital firmly outpaces their debt costs. And finally, step 4, monitor those quarterly shifts. Look, a leveraged moat is powerful, but it can narrow fast if a sudden supply chain shock hits, new federal regulations drop, or a rival makes a huge technological leap. By adopting a strict routine to monitor their leverage and returns every single quarter, you secure your long-term gains, you know exactly when to exit, and you protect yourself from sudden market volatility. So before we wrap up this explainer, you really need to run your own portfolio through this growth velocity filter today, because mastering the dynamics of the debt to equity ratio, it isn't just about avoiding risk. It is literally the ultimate secret to modern wealth building. Look closely at your current holdings and ask yourself honestly, are you betting on a high growth star that knows exactly how to use capital as a weapon? Or are you secretly holding onto a zombie company that is teetering on the verge of insolvency? The answer is right there in the math.